Welcome to the Globe Life First Quarter 2025 Earnings Release Conference Call. My name is Alan, and I'll be your coordinator for today's event. Please note this call is being recorded, and for the duration, your lines will be on listen only. However, you will have the opportunity to ask questions at the end. This can be done by pressing star one on your telephone keypad. If you require assistance at any time, please press star zero and you'll be connected to an operator. I will now hand you over to your host, Stephen Mota, Senior Director of Investor Relations, to begin today's conference. Thank you.
Thank you. Good morning, everyone. Joining the call today are Frank Svoboda and Matt Darden, our Co-Chief Executive Officers, Tom Kalmbach, our Chief Financial Officer, Mike Majors, our Chief Strategy Officer, and Brian Mitchell, our General Counsel. Some of our comments or answers to your questions may contain forward-looking statements that are provided for general guidance purposes only. Accordingly, please refer to our earnings release and 2024 10-K on file with the SEC. Some of our comments may also contain non-GAAP measures. Please see our earnings release and website for discussion of these terms and reconciliations to GAAP measures. I will now turn the call over to Frank.
Thank you, Stephen, and good morning, everyone. In the first quarter, net income was $255 million, or $3.01 per share, compared to $254 million, or $2.67 per share a year ago. Net operating income for the quarter was $259 million, or $3.07 per share, an increase of 10% from a year ago and slightly higher than our internal projections. On a GAAP reported basis, return on equity through March 31st is 19%, and book value per share is $64.50. Excluding accumulated other comprehensive income, or AOCI, return on equity is 14.1%, and book value per share as of March 31st is $87.92, up 11% from a year ago. In our life insurance operations, premium revenue for the first quarter increased 3% from the year-ago quarter to $830 million. Life underwriting margin was $337 million, up 9% from a year ago, driven by premium growth and lower overall policy obligations. For the year, we expect life premium revenue to grow around 4%. As a percent of premium, we anticipate life underwriting margin to be between 42% and 44%. In health insurance, premium revenue grew 8% to $370 million, while health underwriting margin was down 10% to $85 million, due primarily to higher claim costs at United American resulting from higher utilization. For the year, we expect health premium revenue to grow in the range of 7.5% to 8.5%, and anticipate health underwriting margin as a percent of premium to be between 24% and 26%. Administrative expenses were $88 million for the quarter. The increase over the year-ago quarter is primarily due to higher information technology, employee, and legal costs. For the year, we expect administrative expenses to be approximately 7.4% of premium. I will now turn the call over to Matt for his comments on the first quarter marketing operations.
Thank you, Frank. At American Income Life, life premiums were up 6% over the year-ago quarter to $438 million, and the life underwriting margin was up 5% to $196 million. In the first quarter of 2025, net life sales were $99 million, up 1% from a year ago. And as a reminder, we had a difficult comparable this quarter as American Income had a 17% increase in life sales in the year-ago quarter. The average producing agent count for the first quarter was 11,510, up 3% from a year ago. The average agent count declined from the fourth quarter, but I would attribute this to the tremendous agency growth produced over the last couple of years. From the fourth quarter of 2022 to the fourth quarter of 2024, average agent count grew 29%. And it is typical for our agencies to see some contraction after periods of significant recruiting success. We are pleased to see productivity has increased as more agents are submitting weekly, and I am confident we will see continued growth in this agency going forward. Now at Liberty National, here the life premiums grew 6% over the year-ago quarter to $96 million, and life underwriting margin was up 3% to $32 million. Net life sales increased 4% to $22 million, while net health sales were $7 million, down 5% from the year-ago quarter. The average producing agent count for the first quarter was 3,688, and this is up 8% from a year ago. I continue to be excited by the agent count growth at Liberty National, which is primarily driven by recruiting activity and growth in agency middle management, and is a good leading indicator for continued sales growth at this division. At Family Heritage, health premiums increased 9% over the year-ago quarter to $112 million, and health underwriting margin increased 10% to $39 million. Net health sales were up 7% to $27 million, and this is due primarily to an increase in agent count. The average producing agent count for the first quarter was 1,417, up 9% from a year ago. And this is 3 consecutive quarters of strong agent count growth for this division and is driven by this agency's focus on recruiting and middle management development. In our direct-to-consumer division, the life premiums were down 1% over the year-ago quarter to $246 million, while life underwriting margin increased 10% to $64 million. Net life sales were $25 million, down 12% from the year-ago quarter. And as we have previously mentioned, the continued decline in sales is primarily due to lower customer inquiries as we have reduced marketing spend on certain campaigns that did not meet our profit objectives as a result of higher distribution costs. Our focus in this area is having a positive impact on our overall margin, as we will continue to focus on maximizing the underwriting margin dollars on new sales by managing the rising advertising and distribution costs associated with acquiring new business. And the value of our direct-to-consumer business is not only those sales directly attributable to this channel, but the significant support that is provided to our agency business through brand impressions and sales leads. And as we mentioned last year, we expect this division to generate over 750,000 leads during 2025, which will be provided to our exclusive agencies. Now on to United American General Agency. Here the health premiums increased 13% over the year-ago quarter to $160 million, driven by strong prior year sales growth. Health underwriting margin was $2 million, down approximately $10 million from the year-ago quarter due to higher claim costs resulting primarily from higher utilization. For the year, we anticipate mid-single-digit growth in underwriting margin due to strong sales and premium rate actions. And as a reminder, the majority of the premium rate increases for 2025 on individual Medicare supplement business will take effect starting in the second quarter. Net health sales were $28 million, and this is up $11 million from the year-ago quarter. Now I'd like to discuss projections. And based on recent trends we are seeing in our experience with our business, we expect the average producing agent count trends for the full year 2025 to be as follows. At American Income, mid-single-digit growth. At Liberty National, high single-digit growth. And at Family Heritage, low double-digit growth. And we are reaffirming the life and health sales guidance we gave on the last earnings call. And as a reminder, of net life sales for 2025 are expected to be as follows. American Income, high single-digit growth. Liberty National, low double-digit growth. Direct-to-consumer, low to mid-single-digit growth. And for health sales, we expect Liberty National, Family Heritage, and United American General Agency to all have low double-digit growth. Now, before I turn the call back over to Frank for investment operations, I want to note that with respect to the inquiries made by the SEC and the DOJ discussed on previous calls, there have been no material developments to disclose at this time. To the extent there is further information to share on any of these items, we will update you accordingly. I'll now turn the call back to Frank.
Thanks, Matt. Now turning to the investment operations. Excess investment income, which we define as net investment income less only required interest, was $36 million, down approximately $8 million from the year-ago quarter. Net investment income was $281 million, down 1% from the year-ago quarter as compared to a 1.3% growth in invested assets. Required interest is up a little more than 2% over the year-ago quarter, consistent with growth in average policy liabilities. The growth in average invested assets and average policy liabilities are lower than normal due to the impact of the annuity reinsurance transaction in the fourth quarter, which involved approximately $460 million of annuity reserves being transferred to a third party along with supporting assets. Net investment income was also negatively impacted by lower short-term interest rates. For the full year 2025, we expect net investment income to be fairly flat and required interest to grow around 2.5%, resulting in excess investment income to be down 7 to 15% for the year. With regard to investment yield, in the first quarter we invested $245 million in investment-grade fixed maturities, primarily in the industrial and financial sectors. These investments were at an average yield of 6.4% and an average rating of A- and an average life of 43 years. We also invested approximately $51 million in commercial mortgage loans and limited partnerships with debt-like characteristics and an average expected cash return of approximately 8.5%. None of our direct investments in commercial mortgage loans involved office properties. These non-fixed maturity investments are expected to produce additional cash yield over our fixed maturity investments while still being in line with our conservative investment philosophy. For the entire fixed maturity portfolio, the first quarter yield was 5.25%, up 1 basis point from the first quarter of 2024. As of March 31st, the portfolio yield was 5.26%. Including the investment income from our commercial mortgage loans and limited partnerships, the first quarter earned yield was 5.4%. Now regarding the investment portfolio. Invested assets are $21.4 billion, including $19 billion of fixed maturities at amortized cost. Of the fixed maturities, $18.5 billion are investment grade with an average rating of A-. Overall, the total fixed maturity portfolio is rated A-, same as a year ago. Our fixed maturity investment portfolio has a net unrealized loss position of approximately $1.5 billion due to the current market rates being higher than the book yield on our holdings. As we have historically noted, we are not concerned by the unrealized loss position as it is mostly interest rate driven and currently relates entirely to bonds with maturities that extend beyond 10 years. We have the intent and, more importantly, the ability to hold our investments to maturity. Bonds rated BBB comprise 45% of the fixed maturity portfolio, compared to 47% from the year-ago quarter. This percentage is at its lowest level since 2007. As we have discussed on prior calls, we believe the BBB securities we acquired generally provide the best risk-adjusted, capital-adjusted returns due in part to our ability to hold securities to maturity regardless of fluctuations in interest rate or equity markets. While the percentage of our invested assets comprised of BBB bonds might be a little higher than some of our peers, remember that we have little or no exposure to other higher risk assets such as derivatives, equities, residential mortgages, CLOs, and other asset-backed securities. Below investment grade bonds remain at historical lows at $506 million, compared to $542 million a year ago. The percentage of below investment grade bonds to total fixed maturities is just 2.7%. Our below investment grade bonds, as a percent of equity, excluding AOCI, are at their lowest level in over 30 years. While there are clearly uncertainties as to where the U.S. economy is headed in the upcoming months, we are well positioned to withstand a significant economic downturn. Due to the long duration of our fixed policy liabilities, we invest in long-dated assets. As such, a critical and foundational part of our investment philosophy is to invest in entities that can survive through multiple economic cycles. In addition, We have very strong underwriting profits and long-dated liabilities, so we will not be forced to sell any of our bonds in order to pay claims. With respect to our anticipated investment acquisitions for the year, at the midpoint of our full-year guidance, we assume investment of approximately $600 million to $700 million in fixed maturities at an average yield of 6 to 6.2%, and approximately $300 to $500 million in commercial mortgage loans and limited partnership investments with debt-like characteristics at an average expected cash return of 7 to 9%. Now I will turn the call over to Tom for his comments on capital and liquidity.
Let me spend a few minutes discussing our available liquidity, share repurchase program, and capital position. The parent began the year and ended the quarter with liquid assets of approximately $90 million. We anticipate concluding the year with liquid assets at the higher end of our targeted range of $50 million to $60 million. During the first quarter, the company repurchased approximately 1.5 million shares of Globe Life common stock for a total cost of approximately $177 million at an average share price of $121.70. Thus, including shareholder dividend payments of $20 million for the quarter, the company returned approximately $197 million to shareholders during the first quarter of 2025. The parent's liquid asset at the end of the quarter, along with the excess cash flows expected to be generated over the last 3 quarters of the year, will provide the parent with $675 to $725 million to meet the needs of the parent, or that can be returned to shareholders in the form of dividends or share repurchases. In April, we used approximately $47 million to repurchase Globe Life common stock, and for the remainder of 2025, we anticipate using approximately $65 million for shareholder dividends. The total amount of excess cash flows in 2025 is higher than in 2024, primarily because of higher statutory earnings in 2024 than in 2023, and due to the inclusion of an extraordinary dividend of approximately $190 million approved late in 2024. The parent company's excess cash flow, as we define it, primarily results from the dividends received by the parent from its subsidiaries, less the interest paid on debt, and is available to return to its shareholders in the form of dividends and through share repurchases. We will continue to use our cash as efficiently as possible. We still believe that share repurchases provide the best return or yield to our shareholders over other available alternatives. Thus, we anticipate share repurchases will continue to be the primary use of the parent's excess cash flows after the payment of shareholder dividends. However, we also intend to reduce outstanding commercial paper balances over the course of the year to be more in line with historical levels. It should be noted that the cash received by the parent company from our insurance operations is after our subsidiaries have made substantial investments during the year to issue new insurance policies, implement new technologies, and enhance operational capabilities and modernize existing information technology, as well as to acquire new long-duration assets to fund their future cash needs. The remaining amount is sufficient to support our targeted capital levels at our insurance operations and maintain the share repurchase program in 2025. In our earnings guidance, we anticipate between $600 million to $650 million of share repurchases will occur over the full year. Our goal is to maintain capital at levels necessary to support our current ratings. Globe Life targets a consolidated company action level RBC ratio in the range of 300% to 320%. As of year-end 2024, our consolidated RBC ratio was 316%, which provides approximately $100 million of capital in excess of that needed to meet our minimum target capital of 300%. As we do every quarter, we have performed stress tests in our investment portfolio under multiple economic scenarios, anticipating various levels of downgrades and defaults. If the estimated losses under our stress tests were to occur before year-end, we have concluded that we have sufficient capital to maintain our target RBC ratios, given the current excess capital at our subsidiaries, and capital resources of the parent while maintaining our share repurchases as planned. For 2025, we intend to maintain our consolidated RBC within the targeted range of 300% to 320%. In addition, as mentioned on previous calls, we continue to evaluate the opportunity to manage capital under an economic framework available in Bermuda. We expect to conclude this work in 2025 and intend to provide an update on the strategic decisions made on the next call. Now with regards to policy obligations for the current quarter. As we discussed on prior calls, we have included within the supplemental financial information available on our website an exhibit that details the remeasurement gain or loss by distribution channel. For the quarter, life remeasurement gain was $8.5 million. This was favorable to management's estimates and resulted in lower life policy obligations than anticipated. The health remeasurement gain was about $400,000. In other life distribution, during the quarter, we completed the recapture of a reinsurance agreement that involved a small block of business associated with our military life business. This resulted in a one-time favorable impact to life margins of approximately $14 million. There have been no changes to our long-term assumptions this quarter, as we will update life and health assumptions in the third quarter of 2025. Due to the continued favorable mortality we are experiencing, we anticipate a favorable margin impact in the third quarter for life assumption updates, as recent mortality and lapse experience are incorporated into these new assumptions. At this time, our guidance anticipates a remeasurement gain in the third quarter related to life assumption updates in the range of $60 million to $100 million, similar to third quarter's life remeasurement gain last year. As Frank mentioned, we anticipated life margins as a percent of premium to be in the range of 42% to 44% for the full year. However, for the first half of the year, we expect life margins as a percent of premium to be in the range of 40 to 41% and 43 to 46% in the second half of the year, given the anticipated favorable impact from third quarter life assumption updates. For the health segment, we anticipate health obligations will continue to be elevated given recent claim trends outpacing premium rate increases on individual and group Medicare supplement business. This appears to be largely impacted by an increase in a select set of procedures taking place in doctors' offices. In addition, although a portion of the premium rate increases for 2025 were effective late in the first quarter, the majority are effective in April, and we will reflect recent claim trends in our 2025 premium rate filings, which will be effective in 2026. So finally, with respect to earnings guidance in 2025, for the full year 2025, we reaffirm our previous guidance and estimate net operating earnings per diluted share will be in the range of $13.45 to $14.05, representing 11% growth at the midpoint of our range. Those are my comments. I will now turn the call back to Matt.
Thanks, Tom. Those are our comments, and we will now open up the call for questions.
Thank you. If you'd like to ask a question or make a contribution on today's call, please press star 1 on your telephone keypad. To withdraw your question, please press star 2. You will be advised when to ask your question. We will take our first question from Jake Matten, BMO Capital Markets. Your line is open. Please go ahead.
Hi, good morning. Just a question on the outlook for health margins. How much of a lag is usually between kind of the rate actions you've taken and when you usually see the benefit flow into your results? I think you mentioned some of the rate increases took effect on April 1. So should we see a significant step up in margin starting in the second quarter, or is there a bit of a timing impact that we should be thinking about?
No. Almost all the rate increases will be effective or in place in the beginning of the second quarter, so we'll see the full benefit of those rate increases. We'd expect margins for UAGA to be in the 5 to 7% range, so about 6% overall for the year.
Got it. Okay. And then, in the health business, you recorded a small remeasurement gain, even though I guess, reported margins for the segment were a little bit weaker on a year-over-year basis. So I'm just curious what was driving like that outcome in the quarter.
There's just, in the current GAAP accounting framework under LDTI, there is just a little bit of volatility that's related to the way that operates for Medicare supplement business, where rate increases are an aggregate rate increase for the entire block. And so there's some cohorts of business where that rate increase is not enough, and there's some cohorts of business where that rate increase is more than sufficient. So it creates a little bit of volatility on a quarter-to-quarter basis.
Yeah, I would just add that if you look at United American, they had a slight, negative remeasurement gain, whereas with respect to Liberty, American Income, and Family Heritage, they all had, small remeasurement gains, and the net of those was about the $400 million or $400,000 that Tom had mentioned.
Thank you.
We will take our next question from Jimmy Bhullar, JP Morgan. Your line is open. Please go ahead.
Hi. I had a question first on your EPS guidance for the year. And you grew sort of in line with your guidance this quarter, but the third quarter is obviously very tough comp. So just wondering what gives you the confidence that you can achieve maybe the middle end of the range, or should we assume, given the results this quarter, that you're much more comfortable with the lower end, but decided not to change the range as a result of that?
Jimmy, we're very comfortable with the range. I think, one of the things we've been wanting to see is actually the continued trends of favorable mortality, which would lead to a life mortality assumption update. And we've seen, really good mortality results, in the third quarter, in the fourth quarter, and now in the first quarter, which gives us a bit more confidence in as we reflect that experience in our assumption updates, we'll see some favorable remeasurement gains due to those updates.
Yeah, then I would just say, in addition to that, Jimmy, that, we are reflecting some of the negative, utilization trends that we're seeing from the UAGA side. So we are expecting that to be a little lower, over the course of the year, and you kind of see the range of underwriting margin percentage coming down on that a little bit. And that's, being offset, the negatives of that are being offset, with some of the positive views that we have with respect to the underwriting margins. Maybe I'll let Matt talk just a little bit about, I think, some of the views on sales and why there's some confidence there.
Sure. And Jimmy, just to your point, I was going to also mention that, the third quarter, the remeasurement gain would be probably in the range of magnitude of what we had last year. So that also kind of gives us some confidence. As Tom had mentioned, our positive mortality experience over the last three quarters that we're seeing. So that's really why we're reaffirming our guidance back to the midpoint, not at the lower end of the range. And on the sales side, we're seeing good, positive trends there. We normally don't discuss, kind of current, but we're a month through the second quarter here, and so we've got what we're seeing is very strong recruiting and agent count growth, as well as sales are in line with our expectations. And so reaffirming our sales guidance for the year based on what we saw in Q1 along with our expectations, and then what we're seeing here early through the month of April in Q2. But, our average agent count just in the month of April is up 3% over where we were ending March, and it's also higher than where we ended at the end of last year. So not uncommon for us to see a little bit of seasonality at the beginning of the year, and that's what we saw, a little bit of weakness, frankly, in January, and and then that ramped up toward the latter half of Q1, and that's continuing. That trend's continuing on here through the month of April.
Yeah, and Jimmy, one last thing I'll add on to that. I think with some of the the better trends that we anticipate for sales for the remainder of the year, some of the, they call it the drag in life premium growth that we, around 3% here for the first quarter, a little lower, than we would like to see. But so we see that really the effects of some of the new sales, and we anticipate lapses at least, stabilizing here over the course of the year. And so as we kind of get to the latter half of the year, still able to, seeing that premium growth pick up a little bit in the second half of the year, being more in that 4.5% to 5% range, and getting that life premium growth for the full year to be, close to that 4%.
Okay. And then on your life business, if we look at the non-deferrable commissions and policy acquisition expense for the life division, it's been running up over the past couple of years, and it was higher in 1Q than it's been in the previous several quarters. So wondering how much of that is economic in terms of you having to spend more money to originate sales versus maybe the result of LDTI or accounting-related items.
A lot of that, Jimmy, is really just due to some of the higher, investments that we've been making in information technology. And as those systems come on, the depreciation from those, as well as, the software from the service and what we're paying, for that, and the data and analytics that's being allocated to the investor, to the acquisition side, none of that's deferrable. So, we're just seeing a little bit of that tick up just because of some of that largely because of some of that higher technology spend.
Okay, and just the last one on your health margins. It seems like for the MedSup product, for you guys and many of the other companies, usage has gone up, so you guys have been raising prices, but it's sort of a constant catch-up where usage continues and claims continue to go up, and you're having to catch up to that. Do you feel that with the higher prices earning in 2Q and beyond, that margins are going to be at normal levels, or is it more you're probably going to need to raise prices more as you get into 2026 season, given just claims usage and inflation?
I think, Jimmy, I think we need to see exactly what happens, but I think one of the things that gives me confidence is, I think this is a very manageable issue when we see short-term increases in health trends, is that we can, in fact, manage that through rate increases. It may take us a year or two to effectively get those caught up, so it may be a little bit longer than a year, but we've been very successful in the past getting those rate increases approved by regulators. And so I'd expect, improvement in 2026, and if we continue to see trend, then it might be we always have a little bit of a timing delay, so we may actually see a little bit of delay in actually getting back to kind of normal margins. But I think the other thing to think about is, this is largely around Medicare supplement business, right? And so for our other health lines, we're not seeing the same level of claim costs. And Medicare supplement, really from a total underwriting margin perspective, is really in that 3 to 4% range of total underwriting margin. So it's a fairly small set of just the core underwriting margins that we see from the business.
Okay, thank you.
We will take our next question from Elyse Greenspan. Wells Fargo, your line is open. Please go ahead.
Hi, thanks. Good morning. My first question, I guess, is on some of the capital stuff. So you guys, the Q1 buyback, right, was, I guess, a bit elevated relative to what the annual guide would imply on a quarterly basis. But I know you guys also said, right, there's going to pay down some commercial paper. So how do we think about, I guess, capital return over the back 3 quarters? Are you thinking it's just even relative to hitting the guide, or would you potentially, depending upon your stock price, look to front run some of the buyback to earlier, Q2, Q3, et cetera?
Generally, we think normally ratable throughout the year, but we will take advantage of kind of market opportunities. So I could see us buying a little bit more in the first half of the year relative to the second half of the year.
Thanks. And then my follow-up, you guys were talking about, I guess, Bermuda, which you were also talking about a bit last quarter. Just any updates there, relative to what's going on this quarter? And I know you guys have been talking about that more being, something that's, beneficial in, 26 and into 2027.
Yeah, we're still working through it. and so we'll plan to update you on the next call.
Okay, thank you.
We will take our next question from Andrew Kligerman, TD Securities. Your line is open. Please go ahead.
Hey, good morning, everyone, or actually good afternoon. Going back to the health margins, you had been guiding to 24 to 20. You're guiding now to 24 to 26 versus 25 to 27. And I'm thinking, you kind of gave a time frame where you start to see improvement in 26, but you really don't get to where you need to be or would like to normally be until 27, if I understand it correctly. Could you give us a sense of what historically have been normal margins and maybe work through the timeline, when you're actually going to get the price increases? It's going to be gradual? Maybe just walk through the timeline a little more granularly and where a normal historic ratio has been.
Yeah, Andrew, I'll start on that and then let Tom or Matt add. But you do look at kind of the post LDTI, the margins on that business on the UAGA side have been a little bit on the sound like that 10-11%, and I think from an overall health somewhere more in the upper 20s. Overall as a margin percent of premium income. I think with respect to UAGA and the MedSup specifically, we would be looking into getting the cost and the higher utilization that we're seeing here in the last couple of quarters of 24 and at least here early in 25, and working those into our third quarter premium rate adjustments that we'd be filing that would be effective in 2026. Depending upon where the utilization trends kind of take, how those emerge over the remainder of the year, will really kind of inform whether or not, can we really capture all of the increase that we need in those third quarter rate filings or not, or is there some of that'll be, that we're chasing a little bit into 2020, the 2027 as well. We do anticipate getting the full margins for that UAGA to be, closer to that, 5 to 7% range. So second half of the year, being a little bit north of that because, at least the utilization that we were seeing here in the first quarter clearly outran the impacts of the premium increases that we had put into place. We do think with the premium, the majority of our premium increases coming into play here in the second quarter, that will help over the course of over the remainder of the year.
That was very helpful. Maybe shifting over to the life insurance premium, you've been guiding to that, and you mentioned it on this call. You've been guiding to 4.5%, 5%, and now you're looking at 4% for the year. Could you give a little more color on lapsation, why you may be seeing a little higher, more elevated lapsation, and how to think about that going forward?
Yeah, I think from a lapse perspective, at American Income, we are seeing a little bit higher lapses in the first year, and question for us is whether that's fluctuations or a trend, and is virtual sales kind of just driving a more normal higher lapse level in the first year. But I would say that renewal rates for AIL have been fairly consistent over the past 4 quarters, so those seem to have stabilized. I think DTC lapse rates, are consistent with prior quarters and maybe slightly improved in the first year, which is a good sign. And renewal lapse rates are fairly consistent with historical levels as well. So those seem to be all going very well. I think it's kind of a testament to the resiliency of our customers, even in times of economic stress. Our lapse rates move just a little bit, plus and minus, depending upon what the economic environment is. And then for Liberty, that's first overall lapse rates have been relatively stable as well. So I think we're feeling okay about lapses. We'll certainly keep an eye on it. And then I do think that sales that emerge over the course of the second half of the year will actually add to premium growth above first quarter sales growth, and so that's kind of where we're looking at that 4%, around 4% premium growth, life premium growth for the year.
Yeah, Andrew, the one thing I'll add to that is that, we did start seeing some of the, lapses, especially in the first year at AIL and maybe a little bit on DTC tick up toward the latter half of last year. So obviously that, just kind of look at it period over period as those increases in lapse rates year over year take effect. That has that drag on premium growth on the same year over year period. As we kind of look out over the latter half of the year, and we kind of see some of this stabilizing, even though they're maybe running a little bit higher than long-term averages, just because of some of the economic uncertainty. But, as we look back at other periods of some economic stress, where the rates that we're seeing, even at especially at American Income on their first year, are not out of line at all. But as we look at the comparables then, in the latter half of the year, we see that as really being stabilizing, and so that'll help with the period over period premium growth as well.
Maybe just one other comment is, we don't see dramatic changes in lapse rates even in periods of economic stress. They're relatively narrow changes, and kind of as we've looked at this for AIL and DTC under where there's been more economic stress, the lapse rates in renewal years have moved, less than 1% to a little bit over 1%, depending upon the policy duration. So again, I think really a testament of the resiliency of our in-force book of business.
And then that was very helpful. One last quick one. I saw a line item for legal proceedings, $4.8 million. Maybe this is not an answerable question, but could that be an indication that maybe you're coming toward the tail end of the back and forth with the regulators? Is this an indication that we can see more of these type expenses? I don't know. I was just kind of throwing it out there to see if there's some kind of read through on that number, which I hadn't seen before.
Yeah, I don't know if there's anything to read through that. Andrew, I think from time to time we're subject to litigation, and it's common in the industry, the insurance industry. So, the uptick in litigation claims and expenses over the past several quarters, they've really been stemming from claims made by recent short sellers. So, some of that, hopefully subsides. And this quarter, the legal proceedings includes an estimate for settlements related to an outstanding litigation, not related to the DOJ, SEC matters, as well as certain other legal expenses as well. So there's a number of items that can come through there, but they're usually not related to the normal operations of the business and not indicative of past performance or future prospects of the insurance operations, and that's why we put them below the line.
Thanks very much.
Yeah.
We will take our next question from Wilma Burdine, Raymond James. Your line is open. Please go ahead.
Hey, good. Does the higher life margin in the second half of 2025 imply a more favorable run rate in 2026 and beyond, or how should we think about that? Thanks.
Yeah, I think after you end up making the assumption changes, I think from a policy obligations perspective, you would expect it to be a little bit higher run rate going forward. Then keep in mind that we are continuing to still see over the next couple of years, at least probably into 26, some of the increases in amortization expense just because of the transition to LDTI that we've talked about in the prior calls, as well as kind of the renewal commissions. So there's probably a little bit of a tick up in the amortization that we're still going to see over the next couple of years. So I think looking forward, it's probably somewhat of a,
probably in the range. Yeah.
So probably
Similar range to what we've seen in the first half of what we
20.
anticipated in the first half of 25.
Yeah.
Yeah.
Okay. And then life sales were below full year 25 guides in the first quarter, but you maintained the full year outlook. Could you just talk about some of the dynamics in the quarter and what you're seeing over the balance of the year? Thanks.
Sure. Really, January was softer than we anticipated, and as we've talked before, a little bit of recruiting and sales on the agency side is kind of a momentum game, as they would say. And so with the holidays, both Christmas and New Year's falling in the middle of 2 weeks running, kind of really started all of our agencies off to a little bit of slow start in January that ticked up through the remainder of the quarter. And so, as I mentioned to an answer of our earlier question, you know, we also looked at what was going on in April, and April sales are consistent with our expectations, as well as our agent count growth in April as compared to March, or as compared to the prior year end, is higher. You know, it's about a 3% higher just in the month of April, our agent count across all three agencies. And so that trend that we were seeing in the last half of Q1 is continuing now here in the first part of Q2. Now, I'll have the caveat of 1 month does not a quarter make, but you know, the trends continue to be positive, and so that gave us the confidence to reaffirm our sales guidance for the year for all of our various distributions, because we're really not seeing anything significantly different than what our expectations were.
Okay, thank you.
We will take our next question from John Barnidge, Piper Sandler. Your line is open. Please go ahead.
Thank you for the opportunity. You talked about intention to have an opportunity to reduce commercial paper this year. Where do you intend to get it to? Thank you.
Yeah. Our commercial paper balances historically have been in that $300 million range, and so we're kind of looking to bring it down from where we are today, right around 410, closer to that $325 million range.
Yeah, and John, if you kind of look back at a few years back, 2022, 23, we were probably running around 3% of our total capitalization, you know, including the short-term debt. You know, it's about 3%. You know, last year it got, you know, we ran that up a little bit more, and it's closer to 4%. So probably looking at bringing it back closer to that level, that 3% level.
And John, we're looking at a debt to capital ratio at the end of the year right around 25%, which is kind of in the midpoint of kind of our operating range for, or normal operating range for debt to capital ratios.
Thank you for that. That's helpful. My follow-up question, is the increase in health usage more frequency or severity driven? I was reading about some human bandage fraud article recently, so curious about that. Thanks.
It's a great question, John. It is, you know, utilization is the big driver, but one of the causes of utilization increase is related to claims related to bandages, these specialty bandages, which does have a higher claim cost to it. So it's adding a little bit to the average claim cost as well. And that's something that, you know, we are taking action on to mitigate the impact of any fraud that's apparent in that from those billings. So we're taking actions there to help manage those costs.
Yeah, I think one of the challenges on that, John, is that given that some of those new procedures, and I think, you know, the article that was out there kind of talked about that, is that they tend to be higher cost until they really get, you know, worked through, and then they become kind of more of the standard Medicare reimbursement rates, and then that will, you know, tend to bring the rates down over time. But at least that is at least one of the drivers, and we're seeing a few other procedures that are being done in the doctor's office that are also you know, giving rise at least to you know, some of our higher costs.
Yeah, I was going to say, I think that's some of the things that give us confidence that we can manage through this like we've done for the decades that we've been writing this business is that a lot of our trend is associated with a few specific procedures in the office. And so as we work through that, as Frank mentioned, the adjustments that most likely will happen on the allowables as these new procedures get in to the CMS allowables, then, going forward, coupled with continued rate action, I think we'll be able to manage through that. It just may take us one more cycle.
Yeah, as Tom mentioned, this is actually one of the areas that we're really trying to spend some time and looking at how do we use some artificial intelligence, use our data to really try to identify areas of potentially fraudulent claims that are coming through, working with CMS, to try to stem some of that, but really taking a look, of where we might have some of that. Not always can we get it done before we end up paying a claim because of the way we're connected with CMS, but we continue to make, advances on where we can reduce some of that fraud cost, on our side.
But all those trends are industry trends. They're not unique to United American.
Thank you.
We will take our next question from Tom Gallagher, Evercore. Your line is open. Please go ahead.
Good afternoon. My first question is just in your guidance for 25 on health margins, are you assuming that this claims frequency issue stabilizes at current level, gets better, gets worse? What is the trend assumption you're using? It sounds like you got your arms around the rate increase earn-in, but what about the on the claim side? What are you assuming?
We're assuming that it stays elevated at least through the second quarter, and then expected to moderate just a little bit in the second half of the year, which it tends to moderate generally as deductibles are used up. That we're able to that the trend would tend to moderate a little bit in the second half of the year.
So when you say remains elevated, so at a comparable level to Q1?
Yes. Yep.
Gotcha. And then,
but again, just to be clear, the level of Q1 from an obligation perspective doesn't reflect the premium rate increases that are coming into play for the remaining 3 quarters of the year.
Understood. My follow-up is, how do we think about what all of this means for 25 statutory earnings? Because the reserve release that the 60 to 100 million, that GAAP only, or is there any statutory impact for that? Because I presume the stat earnings on the health side are going to be consistent with GAAP, meaning they'll be weaker. But life, I'm a little less clear on whether you will see some kind of benefit, or is that a GAAP only? And so meaning, long-winded way of asking, is 25 stat earnings likely to be weaker than 24?
That's a great question. The 60 to 100 million is a GAAP assumption unlocking, so it's GAAP only. But when we see favorable claims trends, 100% of those, that benefit comes through on the statutory side, where on the GAAP side, generally there's a smoothing mechanism that spreads good claims or bad claims over the future. So we should, favorable mortality will impact statutory results in a favorable way as well.
Yeah, the one
Got
thing
it. So sorry, go ahead.
Well, to say that as we think about, 25 statutory earnings versus 24 statutory earnings, I think I just wanted to make clear as well. Tom, I agree with Tom that the favorable experience that we're seeing will work its way through statutory income as well. Remember that we did have that the reserve revaluation adjustment in 2024, and as Tom has talked about on the last call, while we still anticipate some continuing benefits from that in 2025, we don't anticipate seeing them at the same level that we had them in 2024. So there'll be a little less statutory income generated from that reserve valuation adjustment, probably to the tune of roughly $75 million or so.
Okay, thank you.
We will take our next question from Ryan Krueger, KBW. Your line is open. Please go ahead.
Hey, thanks. Good morning. I had a related follow-up. I think you gave the free cash flow for the rest of the year. I was trying to back into, I think, the first quarter, but figured I would just ask. If you just have the full year free cash flow expectation for this year?
Yes, excess cash flow is expected to be $785 to $835 million for the full year, unchanged from where we were last. Yep.
And then I guess just kind of coming back to what you were just talking about, so that for when thinking about the moving pieces next year, you won't have the reinsurance benefit, and then you'll have less of the valuation manual benefit. Are those the two key moving pieces we should think about?
Yes, the reinsurance benefit we won't have, and then a less of an impact on the valuation manual changes, but also a favorable impact to just growth of the business and the favorable mortality trends that we're seeing. You know, kind of in my estimation, run rate for excess cash flows would be in the 500 to 600 range, kind of going forward. So I'm thinking more midpoint of that range.
Okay, perfect. Thank you.
Yep.
We will take our next question from Wes Carmichael, Autonomous Research. Your line is open. Please go ahead.
Hey, thank you. Good afternoon. On the remeasurement gains and assuming $60 to $100 million with the 3Q review, are those pretty much baked in your view, or could there be some deviation? And I guess it's not that small of a range at $40 million, so maybe what might drive that higher or lower in the next couple of quarters? And, you know, really what is that the determinant of where you come in your EPS guide, do you think?
It's definitely included in our guidance range, right? So that is, you know, part of what's incorporated in there. On the pluses and minuses, it really is. It's a very detailed process to go through setting the assumptions, and so you know, the assumptions are very I'm going to say detailed with regards to issue years, issue ages, attained ages, genders. So there's a lot of pluses and minuses that go across, and so until we actually put those into our valuation systems, that will kind of determine exactly what that result will be. So, you know, so I think until we do that, that's why we have a bit of a wider range as far as where we think that estimate will be. So it's really kind of the implementation of changes and the final determination and judgment around what changes are made.
Yeah, the one thing I would just add to that is that, I mean, that's, you know, kind of what we've seen here through the first quarter, as Tom kind of mentioned before. We really like to see, again, how does mortality and lapses really prove out in second quarter, because that'll have some influence on it. It's not, you know, a final determination on it, but you know, it's the ability to kind of test those final assumptions and where they kind of land. So just, and because the reserves are as big as they are, you know, minor changes of some of those, you know, the assumptions, you know, can move that number around a little bit. So while there's some, you know, pretty good confidence within that range, it definitely can move just a little bit of what we see here in the second quarter and how that kind of influences, you know, those final decisions.
Great, that's helpful. And I guess just a quick follow-up, but the rate increases that you're going to have in health and med sup, do you expect some elevated lapses as policyholders receive those rate increases?
We definitely see a little bit of drop-off when we do rate increases, but in general, I think they value the coverage that they have, and you know, they're fairly persistent.
Yeah, I think that goes back to the comment that was made earlier, is that what we're seeing really is not unusual. You know, as far as, I don't think it's limited to just United American, and so it's an industry situation. So we would anticipate that other carriers would be raising rates as well, and then that's where maybe the the Medicare Advantage dynamic comes into play a little bit, that, there's still some issues out there we are seeing with acceptance with Medicare Advantage and where that coverage is going and dropping, doctors in networks and things like that. So where that's been, perhaps a little bit of a tailwind this past year, and we'll have to see where that kind of, it's a little bit of a wild card where that goes. But, that's why we don't really anticipate that there'd be a large scale, drop off or lapse if in fact we were to, as we put in our rate increases.
I think the industry's seeing trend and everybody's pricing for it accordingly. So.
Yeah.
Great, thank you.
We will take our next question from Suneet Kamath. Jefferies, your line is open. Please go ahead.
Great, thanks. It sounds like some of the confidence you have in terms of maintaining the guidance for sales and such is April results. But I'm just wondering, just given how quickly things sort of changed in April, normally when you see these shocks, is there a little bit of a lag between, kind of the environment changing and then when it impacts your customer behavior, or does it sort of catch up, or does it kind of show through pretty quickly there?
Yeah, let me start with, it's not just April. It was the trend that we were seeing throughout Q1. As I'd mentioned, January was softer than we anticipated, but looked at how February and particularly March performed, and then we're seeing that trend continue through April. So it's really the results of multiple months. And how we think about that is we look at the momentum in our agent count with recruiting and growing our overall agents that are producing and submitting business. And so that is really a precursor, a leading indicator to ultimate, sales growth. So, we're also seeing, as I've mentioned before, we track our agent onboarding recruiting pipeline before they ever start producing business. And so people that are in the early stages of that pipeline before they get a license and start selling, we're seeing double-digit growth in what we call our hires, or people that are starting in that process. And so that bodes well for future growth as well. And on the consumer side, we generally don't, we've talked about this before, see significant impacts based on economic factors to our customers. I think that really gets back to our customers value our products. They have a need for that. And, more than 50% of our demographic does not have our coverage. And the affordability of our policies, where it's $30 or $50 or $60 a month, still makes that affordable. And what we really see is that as long as our customers have jobs or employed, that they still find value in the products that we're offering, as well as the cost of what they're trying to cover from an experience perspective. As those costs go up, we see them taking out more coverage. And so what I continue to be encouraged about is if I look at the trends of just the premium on a per policy basis, those trends are up in Q1 compared to last year. And so people are paying a little bit more to take out a little bit more coverage for their needs. So we're really not seeing any weakness there. And I'd say that's consistent. We go back to, the 2008 through 10 time frame, 2020, 21. We had double-digit growth in our agent count. We had double-digit growth in sales across those time frames. And so, I think that bodes well. One last comment I was going to make and kind of circle back to, I realized I didn't completely answer Wilma's comment, which I think will also, or question, which I think will also get to part of your question as well, is that I failed to mention our direct-to-consumer channel. I'll say that is, we anticipated on our annual sales guidance that would kick in the latter half of this year. And so Q1 results are not dissimilar from what our expectations were, and that's why you see we reaffirmed our overall sales guidance for our direct-to-consumer channel. And a lot of that is based on some of the things that we've been working on for quite some time related to underwriting automation and some other tools and data that we're using in that organization. We've been testing that for quite some time and anticipate that coming more fully online in the latter half of the year. And that will really help with our issue rates and really help us increase there. And so that's why our guide is low single digits overall for an annual basis for DTC, is some of the good things that we're doing there, and it relates to some of that technology spend we've been talking about for quite some time, seeing that come into fruition.
Okay, that makes sense. And then I just have one more, and thanks for going over a little bit. Just on the reviews, I mean, I know you said that there's nothing new to, update us on, and I get that's fine. But is your expectation still that at some point we will get sort of a, all clear, and any sense of how close we are to something like that?
We do anticipate, and that's what we're working through, these processes of having a finalization that we can communicate, so that is definitely our goal in that area. It is hard to handicap the time frame, just you're dealing with, as we've mentioned before, governmental agencies that don't have a lot of transparency in where they are in the process. I would venture to say that there's been a little bit of distraction in the government system, so to speak, over the last several months, and that may bode well from a long-term perspective for us, from a lower regulatory burden, but in the near term, it might cause a little bit of slowdown in some processes. So hard to handicap time, but we definitely anticipate having the opportunity to be able to report out conclusions on those matters.
Okay, thank you.
There are no further questions on the line, so I will now hand you back to your host for closing remarks.
All right. Thank you for joining us this morning. Those are our comments, and we'll talk to you again next quarter.
Thank you for joining today's call. You may now disconnect.